All right, so welcome to the JDC West 2022 accounting case presentation sponsored by CPA. Thank you to our judges, Alex Mariano, Gita Tucker, Nikki Bello, Gary Sorba, and Sana Anwar. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. Competitors, you will see Zoom chat notifications at various intervals to indicate the remaining time. Any speaker who continues to speak after the maximum time limit will be stopped. No questions or comments will be permitted from the audience. All judges are asked to have their microphones muted during the presentation. The audience is banned from any material or naming convention that bears the name or symbol of the competing university. And we ask that the audience leave the Zoom call immediately following the presentation. Judges, please stay on this call until I advise you to move to the next call. And competitors, you may begin your presentation.
I would first like to thank the judges for taking the time out of their schedules to be with us here today. Life is all about change, whether it's big change or small change. It can be something simple as changing your coffee order, or it can be something as big as moving on with the next big stage of your life. What's important to know is how to move forward after change happens. For example, you now just had your kids leave your nest. It's time for you to change with your life. You want to focus a little bit more on your business and to grow as a person. We here have created a plan to make sure that this next station of change will go as smoothly as possible for both you and your husband, Dwayne, here today. My name is Kyle. These are my associates, Tyler and Ben, and we are Capital Consulting. And as you can see, we have put together a plan to help you and Three Kings grow together. So as you can see, this is a high-level overview of our plan here today. We're aiming to help make sure that Three Kings can become the go-to marketing company for any digital marketing means. We will break down exactly what we mean by this by first diving into the primary problem that we have identified for you here today. So of course, a quick question we have for you is, how can Three Kings maximize their growth? Now, what type of partnerships are you going to look into to create this growth and foster development? Should you be looking to that SIR, that UCA partnership? And how exactly will that impact your company? And should you be looking to setting up those offices in downtown Toronto, or would that be better to avoid those for now and to find those at a better date? These are great questions. We'll be diving a little bit more into those. We also have to look down at the secondary problems. These are problems that aren't as pressing, but they're just as crucial to your business. We have those implications from the partnerships. Exactly how might those certain partnerships affect your company, both financially, socially, and ethically? How might certain things like your cash flow and your financing happen in this company? How might that affect things like your liquidity or your cash on hand, especially as you're trying to take on these larger and larger projects? And finally, with the entire pandemic, how exactly are you going to navigate that? How might future lockdowns impact the decisions you're going to have to make, like things like purchasing an in-person office? Should you try to go in person, or should you try and stay virtual for now? These are very important questions that we're going to be breaking down for you shortly. Now, of course, we want you to take a look at the ethical considerations for your company. It's important for you to not only just care about the profits, but the people around you. And we want you to pay mind to this one quote for you here today, as that the actions taken towards your clients will define your company's values and public perception. Things like choosing what rates to charge for the Truth and Reconciliation Initiative, to whether or not to tell your friend Jill about the Bell Mobility Inside movements, whether or not to take on your role as a UCA employee when you're not actually unemployed in their organization, or to work with SIR Corporation despite some controversies with their CEO. You need to understand how all of these different issues will impact your company. Now, as you see here, we've done a little bit of analysis into the internals of your company. We can see that, as we mentioned before, you've already been in this industry for a while, right? You, Shauna, have connections with the industry and with other people in this area. Additionally, it's also important for you to understand that there is a well-defined target market in place for you already. You already are servicing that dynamic digital marketing sector, which not many other small firms are looking to do. And additionally, you'd have to pay attention to some drawbacks for your company. You still have that lack of funding. Like we mentioned, cash flow is a concern for your business, but with the plan that we're laying out here for you today, it will not be in a year's time. And at the same time, you also have limited human capital, since you, Shauna, are the sole employee of the company. It's limiting your operational capacity and preventing you from reaching your full potential for now. Now, our main takeaway for you here is that While you are ready for expansion, there's just some resource limitations in the short term that if you come over that, you're going to be well set for the next few years moving ahead. Now, I also want you to look at the industry itself. What type of market segmentation is happening with marketing companies? Well, that's great because it's clearly defined and split into different segments depending on firm size and what industry you're looking to service. And similarly enough, as a small service firm that's working in digital media, it's perfect because consumer trends are moving towards your specific type of specialization. Of course, like we mentioned, like with your company and many other companies, cash flow issues are a pressing concern. However, and then there's the other issue of the difficulty to retain the customers. As mentioned before, it's very easy for clients to switch between marketing agencies. And as we saw that, you need to figure out some sort of way to retain your customers along with obtaining new ones in order for you to remain profitable. Main takeaway here is that the industry itself is moving forward to your niche with 3 kings. So all you need to do is figure out how to keep on getting and retaining those customers, and that'll help fix your cash flow issues, and that'll make sure that your business is well set for the years to come. Now, I just want you to pay attention to one more analysis here today. There's only 3 numbers you need to look at right here. You have your net profit margin, which is sitting at 7%. Now, that's a little bit tight, I'll admit it. But as you know, working in the marketing industry, you're working with a lot more with operational expenses rather than variable costs. So as you grow with economies of scale, we're looking to increase that margin in the years to come. Additionally, we also see that the average Canadian will spend around 83.4 days per year just looking at digital media. This is perfect because once again, this is right up your alley as a company. And then finally, we want you to look at this digital to traditional spending ratio, which means that around $1.80 is spent for every dollar spent on traditional marketing to digital marketing, meaning that around twice as much money is being spent on digital marketing in comparison to traditional. Now, our main takeaway here for you is that with your tight profit margin, you can still take advantage of these shifts in consumer trends and use that to make your company more profitable and more successful in the years to come. I'd now like to invite my associate, Tyler, to speak a little bit more on our decision criteria and our recommendation here today.
Thank you very much, Kyle. And thank you again, judges, for joining us. We're very excited about our recommendation that we have for you today. And first of all, to dive into the decision criteria behind the recommendation that we have for you, the 3 things that we think are the most important to take into consideration. The first would be the brand image. Obviously, as we mentioned, in the market segment of digital advertising, there are many different options for competitors, so it's important to maintain a good brand image. Secondly, risk aversion to mitigate any of the uncertainties and the risk that has come with the pandemic, all that may carry. And finally, the growth opportunities. Shauna, you mentioned that you're looking to grow 3 Kings into a very profitable and successful company, and we want to make sure that that is achieved. First of all, we're going to take a look at a qualitative set of factors for partnering with either SIR Corp or UCA. First of all, we're going to look at SIR in terms of qualitative analysis. Some of the benefits of partnering with SIR Corp would be that there are connections with the company. As you mentioned, Shauna, you already are connected with George, the VP Marketing at SIR, so that would be a good connection to maintain. And as well, there are a variety of different growth opportunities. Mentioned that you are able to move outside of the segment and pursue different market segments such as the creative or any of the actual creation of the digital media. Some of the cons, however, is that there is a bit of a lack of stability as there is not consistent revenue streams year after year. They're not sure if this contract could be attained next year. There's a bit of controversial branding in terms of the CEO's outlook on the pandemic. And finally, there are a little bit of tighter margins than our example that will come up right away here with UCA. We've listed our decision criteria across the bottom there, which have mostly been unmet for the short term, except for growth. Now we're going to take a quick look, qualitative dive into partnering with the UCA growth opportunity. As you can see here with the qualitative benefits and drawbacks, it will be highly profitable, as I will get into in the next slide here. There is lots of good exposure as UCA is exposed to many high profile clients that they take on. And finally, there is low risk because of the high profit margins that will be associated with this option. And finally, the drawbacks, there is a smaller area of focus as it is focused again only on the media planning side of things, the segment that you are currently in. And finally, there is that questionable employment status in terms of saying that you're an employee of UCA when you actually are not. What you can see across the bottom screen, our decision criteria is mostly met with the exception of brand, which we will touch on again later in the presentation here. Taking a quantitative look now at the comparison between SIR and UCA, what we've done for you today is done a comparison in terms of the SIR profitability and UCA. For the SIR, the sales and cost of sales were relatively steady, which is why those remain the same over our sensitivity analysis. However, there were a range of salaries that were provided. So we did a sensitivity analysis based on the high and low options for those. And as you can see, the net profit is listed along the bottom of the left-hand side. And for UCA, Sean, I understand you had a bit of reservations about the success rate of the trials that UCA would be going with their clients. They had thought that it was going to be 60. You were thinking more 40%. So we did a sensitivity analysis based on that as well. The key takeaway from this slide is that the net profitability of UCA is much larger than SIR. The thing I would like to stress, though, is that both are positive and both would be good investment opportunities, might just be at different times. As I will indicate in our next slide here, what we have also done is taken a look at the cash flow projections for SIR Corp on these two graphs here. The graph on the left-hand side is from January to June, and the graph on the right-hand side is from July to December. What I would like to emphasize on this slide here is the line that goes across the graphs. That is the ending cash balance across the entire 2022 year. As you can see, it always stays above zero, meaning that however minimal the net profit is for SIR, it still would be a good investment and still would help with cash flow. And we will touch on how that fits into our recommendation a little bit later in our presentation here. Now, we'd also like to touch on some of the cash flow considerations. We understand that cash flow timing has been an issue not only for your company, but within the industry as well. Some things we would like to recommend in terms to solve this would be to implement some stricter AR repayment terms from your clients. This could be things such as early payment incentives, as well as interest payments on, or interest penalties on late payments, sorry. Another thing that we took into consideration to mitigate some cash flow timing issues would be to encourage compensation through dividends rather than salaries. This is the case because this would allow for a little bit more flexibility in terms of cash staying within the company. And as well, Shauna, for you, it would provide some personal tax incentives in the form of the dividend tax credit that we think would be beneficial. And finally, we would consider providing a shareholder loan. This would be at a last resort, but if you do have a decent cash on hand, Shauna, you could consider lending some to Three Kings while you're waiting for client payment. And then once that is received to pay off the supplier, then you could receive that shareholder loan back from Three Kings. We also looked into the office lease or buy consideration that you were curious about. As you can see here, the lease or buy options we based off of the total annual expenses as well as upfront costs for both options. The further breakdown of those numbers can be found in the Appendix B at the back of the presentation, and we've also laid it out graphically for you. The key takeaway from this slide here is that there are less annual and upfront costs associated with leasing the building, and there would be less risk in terms of the pandemic and the uncertainty. Therefore, we think leasing would be the optimal alternative to go with. We don't know if it's the best right now with the pandemic, but we believe it is a good option moving forward, as Ben will touch on in our implementation. So for a recommendation for you today, we believe that it would be beneficial for you to pursue immediately the UCA partnership in order to boost those cash flows. And then in possibly about a year's time, look at leasing out a building and pursuing that SIR growth opportunity if they're still looking for a new marketing firm. As you can see here, this does help with brand perception by expanding out to many different companies and getting many different client perspectives, which also helps with growth potential. And finally, the risk aversion with the excessive cash flow coming from UCA. This does mitigate the risk that the pandemic has to offer. Now, one other key point of interest we would like to provide to your attention as well. As we understand, Shauna, you're the only employee of Three Kings, and that leads us to believe that it is a privately owned corporation, meaning that you must follow the ASPE standards, which are for private. One thing we'd like to bring to your attention is ASPE 3400.04, which is revenue recognition. You did ask us if you're recording revenue correctly with one of your campaigns that has gone over your fiscal year end. So in accordance with 3400.04, revenue must be recognized when the service is satisfactorily completed. And so for the campaign that is going over the fiscal year end, the 3 of the 8 weeks completed in the previous fiscal year, 3/8 of that revenue should be recognized in the previous, which was $33,750. And in the current fiscal year, the remaining 5 weeks should be recognized, which is at $56,250. I'd now like to pass it off to my colleague Ben to go over some other considerations as well as implementation for you today.
Thank you, Tyler, for that. So you did ask us some additional questions beyond what we have recommended today. We have come up with some suggestions for you. So in terms of the Truth and Reconciliation initiative that you'd approach us about, we do believe it would not be beneficial for your company to offer a discount for this service. as this may take you down a rabbit hole of other charities coming to you and thinking that they may get a discount as well. So, and that would be a never ending problem. And then when you say no to someone else, that'll become some more public image issues for your company. So however, to mitigate this, we believe that if you donate 25% of the price you charge to this initiative to a charity that is involved with the Truth and Reconciliation Initiative, that would be the most beneficial way to support this issue. And then secondly, you did approach us about some possible financial support, such as funding wages. We did look into this, and based upon hiring 2 employees for the first year on an annual salary of $50,000, we do believe you could claim $1,800 per subsidy period for these employees. This is not necessary, as your cash will be good based upon this plan, but you could find the breakdown of this subsidy in Appendix C. And then secondly, you could consider Ontario has many women entrepreneurial grants. Therefore, you could go ahead and receive lots of these grants for your cash flow issues. And then lastly, in terms of the Bell mobility issue, you could we did take a look into this issue, and however, we think that it would not be beneficial for your company to give insider information, as this may hinder some of Bell's policies and could lead to future ethical issues. So for the implementation today, these are the things that need to happen immediately. First off, agree to this UCA project. However, we do think you need to do a subcontracting agreement to mitigate any possible legal issues. As you can see, it'll have cash outflows of $10 million in the first year and cash inflows of about $12 million. And the breakdown of these cash inflows and outflows can be found in Appendix D. And then secondly, you need to hire and train new employees to be operational for this first year based upon our plan. This will be 2 new employees, and they'll have annual salaries of $50,000. And there will also be $2,500 worth of training costs and hiring costs associated with this plan. And then lastly, take on the Truth and Reconciliation campaign. This needs to happen immediately, as this is a hot topic, and they will be eager to start working with you. This will be about a cash inflow of $50,000. We believe this is a fair market price to charge to this project. And then for the second phase, this is over the first year. You need to first increase your own marketing efforts. We did double your marketing budget. And however, we do think you should do some surveying to keep track of the public image, as that is a concern right now with some of these expansions. And then secondly, you need to make donations towards the Truth and Reconciliation charity by the year end. This will be about $12,500 based upon the $50,000 we suggested you charge them. And then lastly, at the end of year 1, we'd like to have you keep looking into those potential grants. Like I said, you should be well off financially, but it is an option if there are some cash flow constraints. And then lastly, our third phase for today is over the course of the second year of our plan. Here, you will need to hire and train 3 additional employees for this year. This will also have training and hiring costs associated with it, and also 3 more salaries at $50,000. And then secondly, at this point, you are ready to take on the SIR project as long as it is still available. This will have a cash outflow over the first year of about $1.4 million and a cash inflow of $1.5 million. And then thirdly, you need to then acquire the office space. We suggest a lease, and this will have an initial outflow of $120,000. And then lastly, into the future, you need to look ahead for more opportunities, new clients to grow forward. So, and this is just a quick timeline here outlining the details of our plan and when they will start and when they will begin. As you can see, there are a few things that will take more time than others. So for the risk and mitigation we provide with you today, they are on a high impact, high probability scale. First off, what if your brand image is damaged by the partnerships you take on? The mitigation to that, increase the discounts and customer benefits that you offer to these customers to enhance those relationships so you do not maybe lose them in case any brand image issues occur. And then secondly, what if the UCA partnership is not as profitable as predicted? Well, with the UCA partnership, you are developing new client contacts to work with into the future. Therefore, you are now set up for many possible avenues into the future. And then lastly, what if the SIR project is no longer available when you approach them for year 2? You should then take advantage of those client exposures that you have with that UCA partnership. And then lastly, for the key performance indicators today, in terms of brand or image, we do want you to have a net promoter score of 7 out of 10 over the 2 years. This will indicate your brand image is strong. This will be based upon the surveys that you take. And then secondly, the risk aversion, we'd like to see you uphold the 39% threshold of gross profit margin you currently have. This will indicate that the risk has not taken over your company. And then lastly, in terms of growth, we'd like to see you gain and retain 10 new clients by 2025. This will indicate that your company has grown according to our plan. And Kyle will now like to close our presentation for you today.
Thank you, Benjamin. Change can be scary, but it doesn't have to be. If you have a well laid out plan, there's nothing to fear as you go into new uncertain territories and help expand your business. As you can see by the plan we've laid out here for you today, there's no reason why you shouldn't be on top of the industry by this time next year. I would like to thank you for your time.
All right, thank you for your presentation. Moving on to the Q&A period. Judges, please raise your virtual hand to ask your questions and I will call upon you. All right. I believe we'll start with Sana, please.
Hi, thank you for your presentation. I have a question for you guys. My question is, you mentioned that you're going to put interest penalties on late payments. Is that the industry norm? And if not, then how will you ensure that by putting these penalties, your clients just don't go to someone else? Because that is one of the problems in the industry, where the clients can easily switch over to another company.
Thank you for your question. So in order to answer that, we think that the interest penalties could come as a secondary issue. First, you could implement some early discount incentives. And if those don't seem to work, then you could look at doing some interest penalties as well. We understand that you have very good connections with your clients. And we think that is going to make all the difference in terms of keeping all your clients and keeping good customer service in that regard.
All right, thank you. Moving next on to Nikki.
Hi. Thank you very much for your presentation. My question will be based on the assumption of inflation. Was it factored into the analysis to arrive at the scenario to manage the cash flow for the organization? And the other question is, do you factor in the contingency plan? Because you are leasing the office, you are signing some contract with the vendors, and obviously Shauna has to pay them. So what are those things that you put together to make sure the risk are mitigated from inflationary implication and the contingency planning? Thank you.
Thank you. Yes, we did bring all those into the considerations when we were creating the cash flow. And it was of utmost importance to make sure this is going to be as accurate as possible for your company. So taking into considerations like that was very important to make sure that we have the proper adjustments for the amount of cash you're going to be having on hand in the coming years.
All right, thank you. Next, we'll move on to Geeta, please.
Great, thank you for your presentation today. So your recommendations are distributed over 2 years, and you're recommending to pursue both the partnerships, also the leasing of the new building as well. Do you think Shauna can do it all? Does she have the capacity to do it? Are there strategies that you considered to avoid burnout? Thank you.
So with the two options we laid out for you today, in terms of the two partnerships, we do believe that you would have the capacity to operate both partnerships in the first year. However, that'd be risky considering your current cash flow issues. So we did believe that after that first year, you'll be set up to at least take on that SIR project coming in second year. Then, however, we did advise the office, as it's something that you really value going forward. We do truly believe that you will be able to obtain that goal. However, if the risk does worry you a little bit, you could move it back into the future, as the pandemic may still be going on at this point, so you might not be needing clients or your employees in person at that point.
All right, thank you. Is there any more questions coming from the judges panel? No, okay, so we'll stop there. Delegates, you are free to go. Thank you for your presentation. And once again, judges, just please stay on this call until I advise you further. Thank you.
Thank you all very much, judges, for tuning in again.
Thank you.
Thank you.
Thank you.